Is money just a tool or an obsession? For some, money represents security. For others, it is the ultimate test of intelligence, instinct, and power. Steve Cohen was not born into wealth, but from a very young age he understood exactly what money could buy. This is the story of a man who rose from a middle-class home to the darkest and most profitable corners of Wall Street. A journey where intuition meets discipline, risk collides with control, and success exists dangerously close to collapse. If stories like this matter to you, stories that reveal how money, power, and markets truly work, consider subscribing to the channel, liking the video, and turning on notifications to stay with us. And if you have thoughts, questions, or a different perspective, share it in the comments. Because finance is never just numbers, it's interpretation. This documentary is not just about a hedge fund billionaire. It is about how modern financial markets really operate and how easily they can break. This is the story of Steve Cohen. Steve Cohen is deeply impressive. His story is almost a journey from near poverty to immense wealth. He grew up in Great Neck, a wealthy town on Long Island, in a middle-class family. Compared to many people around them, his family had a bit less money. Because of this, from an early age he always carried a desire to become rich somewhere inside him. Even though Cohen was not born into money, he understood very well what money could buy. He lived in Manhattan. Cohen's grandparents were very wealthy, and they frequently took him to luxury restaurants and shows. In other words, he witnessed, and to some extent experienced, the lifestyle of the rich. And as a child, you can be influenced very quickly by everything around you. That was exactly what happened. The lifestyle of Steve Cohen's grandparents had a major impact on him. He saw the kind of life money could buy and wanted to have it. Yet at home, Cohen experienced the complete opposite through his family's living conditions. Born in the summer of 1956 in Great Neck, Cohen was the third of 8 children. The Cohen family was at the lower end of the financial pyramid. Everyone in the family believed Steve would be special. His mother and brother recalled that their mother would cook steak and prepare hot meals especially for young Steve. So there was truly a sense that Steve was special. He was special, genuinely intelligent, and expected to make a lot of money. And because of this, he was treated a bit differently. He needed money badly, and while he was in high school, Steve Cohen, as a young man, found a clever way to earn extra income. Cohen demonstrated an incredible talent for playing poker, because poker teaches you how to deal with probabilities and uncertainty. And that is extremely important for life. In everything we do, we try to manage this. Steve was very good at it. While constantly asking himself questions like, should we go this way or that way? Should I go on vacation here or there? He realized that everything is about dealing with uncertainty and the probabilities of events happening. Poker was a very fun and easy way to teach someone this. Sometimes Cohen would play poker all night and earn thousands of dollars in a single night. He realized that there were easier ways to make money than working a 9-to-5 job, and by playing poker, he could sometimes earn more than his father. Despite the time he spent playing poker, Cohen managed to maintain good grades in school, which eventually helped him gain admission to Wharton for university. Socially isolated, Cohen devoted himself to the only hobby he truly enjoyed: poker. But soon the money he earned no longer satisfied him. He wanted to enter a much bigger casino, the financial markets, and try his luck there. He was extremely confident in himself. While at university, Cohen began working at a notoriously rough trading firm called Gruntal. This was his first job in finance, and it was a small, relatively inexperienced brokerage firm located in Lower Manhattan, very close to Wall Street. The firm was called Gruntal & Company. It was a place full of misfits. It was certainly not a polished or corporate environment. It was somewhat chaotic and disorganized, and most of what went on there consisted of brokers calling individual investors and trying to sell them various stock investments. However, Steve was hired by a family friend from Great Neck, who had set up an options arbitrage desk at Gruntal. As a new hire, Cohen had enough confidence in his abilities to make highly accurate predictions about stocks. He was working for Rono Iser, who specialized in options arbitrage. Mathematically gifted, Iser was skeptical that anyone could accurately predict stock prices, but he decided to give Cohen a small amount of money to make his first trade. Remarkably, Cohen made $4,000 in a single day and another $4,000 overnight. This was a very significant profit. Cohen was described as an intuitive investor. To be honest, what he was doing was not very different from gambling. He had a strong sense of risk and reward. Strangely enough, it was as if he had an instinctive feel. He was highly knowledgeable about the stock market and was often right. People described him as a tape reader, which is a somewhat unusual term. Essentially, before the entire trading mechanism became electronic, there was a physical stock ticker tape, and you could sit there and watch orders entering and leaving the market. According to those who worked with him, he was extremely good at this. He could scan the market, examine all the available news and information about a particular stock, and then sit in front of his screens and make a great deal of money in a way very similar to what we now think of as day trading. So yes, there was a certain amount of natural talent and intuition. For Iser, Cohen was the most talented investor he had ever seen in his life. In the mid-1980s, the American stock market was dominated by mergers and acquisitions. By building positions around events such as takeovers and initial public offerings, Cohen was earning $10 million a year. I think there was also a degree of beginner's luck involved, much like playing poker. No matter how many hands you've won, a single bad bet can wipe you out completely. Today, the Dow Jones Index fell by more than 22%, almost twice the drop of Black Monday, which marked the beginning of the 1929 crash. But the 1987 crisis was not just an American experience. Stock markets around the world fell faster than a skydiver without a parachute. When Reagan took office, the American economy experienced some of its strongest growth in decades. The financial sector was booming and attracting hundreds of thousands of young men into the markets. Cohen grew up in relative poverty, but through years of work he became a star trader at a trading firm called Gruntal. During this bull market, Steve Cohen was making more money than almost anyone else, unaware that a financial bomb was about to explode. Economic growth was slowing while inflation remained high. A weak dollar was putting pressure on exports. Stock valuations reached extreme levels, and overall price-to-earnings ratios rose above 20. Forward earnings projections were lower, yet stocks remained unaffected. All of these conditions created a perfect storm. Black Monday, the stock market crash of October 1987, caused US markets to fall by nearly 20% in a single day. Gruntal, like many other firms, nearly went bankrupt. Cohen's group lost almost half of its capital. Each of his 7 traders was nearly wiped out by the losses. We see these kinds of blow-ups all the time. Of course, some traders may be skilled at predicting a stock, but from time to time, the market can fundamentally change. And when that happens, you can lose everything. A truly great trader senses fear and organizes himself in order to take advantage of other people's fear. And ultimately, what defines him is discipline. He does not operate purely from statistical analysis. He sees that as just one element. What he develops instead is an intuition for supply and demand. He knows where the blood is and where people are trapped. This is mind management. As chaos continued around him, he actively kept trading to recover his losses, and in the end, he survived. After the crash, Cohen grew tired of menial tasks and wanted to start his own firm. With a hedge fund structure, he had the potential to make more money with fewer restrictions. In 1993, Cohen founded SAC with approximately $23 million in capital and 9 employees. He invested about $10 million of his own money, and the rest came from traders and friends. Although Cohen's trading strategy was difficult to replicate, there were always a few core principles he followed. Taking lessons from poker, Cohen believed that investing was entirely about taking intelligent risks, and managing risk was what he knew best. he did not become emotionally attached to his positions. He was highly rational and tough-minded. When trades started to go against him, he was extremely good at pulling the plug and selling. And while many people lose more money because they refuse to admit they are wrong, according to everyone who worked with him at the time, Cohen was exceptionally good at remaining objective and analyzing risk in a very calm, detached manner. As a result, he began to make a great deal of money. Within 3 years, SAC grew rapidly, earning millions of dollars and nearly quadrupling to reach close to $100 million. Cohen began buying securities and expensive works of art. He may have been at the top of the world, but he could not see the next crisis coming. The late 1990s and early 2000s saw the greatest expansion of hedge funds, and by 2012, there were more hedge funds than publicly traded companies. At the very top of the hedge fund kingdom sat SAC, one of the most profitable firms ever created. Born and raised in a middle-class family, Cohen built SAC Capital from scratch and earned billions in the process. Cohen's success attracted admiration and attention from Wall Street, and also from places where no one would have expected a hedge fund manager to be working. All of these people engaged in short-term trading, buying and selling stocks every day, were seeking what is known as an edge. This is a common term in the industry. They want an edge. There is the white edge, which is largely useless for their purposes, the gray area, and then the black edge. With the rise of the internet and the widespread access to information, this clearly began to resemble insider information. What makes beating the market so difficult is that the vast majority of academics now believe it is impossible to outperform the market, and that those who do well are simply lucky. In other words, the market is extremely efficient. Prices essentially reflect all available information, so under a strict interpretation of the theory, beating the market is nearly impossible. You are always paying a fair price. I think there is some truth to the argument that beating the market is almost impossible. I believe some of these hedge fund managers know this, which is why they search for information that will give them an advantage. And unsurprisingly, many of them turn to insider trading. One hedge fund manager who realized this was Raj Rajaratnam. The only way to beat the market, he believed, was to cheat. Prosecutors sought the harshest possible sentence for him. In 2010, billionaire hedge fund manager Raj Rajaratnam was sentenced to 15 years in prison for insider trading. But prosecutors soon realized he was only a small-time cheater. There were bigger fish and bigger sharks to catch. Portfolio manager Matthew Martoma began building large positions in 2 pharmaceutical companies developing promising Alzheimer's drug trials, Elon and Wyeth. Many analysts and investors were deeply pessimistic about Elon and Wyeth and could not understand why Martoma and Cohen were building such large, unhedged positions. Cohen said, "Martoma knows a lot about this." However, it later emerged that Martoma's information came from a confidential source, Dr. Sidney Gilman, who was connected to one of the companies. The 2 pharmaceutical companies were scheduled to announce the final trial results on July 28, 2008, in Chicago. But through Dr. Sidney Gilman, Martoma already knew that the trial was a disappointment. SAC aggressively began reducing its large positions in Elon and Wyeth, and even shorted the 2 stocks to bet against them. Meanwhile, the stock prices fell off a cliff. Cohen made $276 million, enjoying this enormous profit while betting millions of dollars against the 2 companies, unaware that this marked the beginning of his downfall. In 2014, Martoma was convicted of what federal prosecutors described as the most profitable insider trading conspiracy in history. At the same time, the SEC brought charges against several other SAC employees. Shortly thereafter, Cohen himself was charged by the SEC for failing to properly supervise his employees. Cohen settled his civil case with regulators in January 2016 and was barred from managing outside money until 2018. Fortunately for Cohen, with the help of his team of elite lawyers, he managed to avoid any criminal charges. Despite this devastating blow, Cohen refused to give up. He now had to look for a new opportunity, one that would allow him to continue generating massive profits. In 2014, the SEC shut SAC down and forced it to convert into a family office. As a result, the ability to control your investments and cash flow through your own family office without other major firms knowing became crucial. And I think this is because we are seeing more and more of this. Many of these structures essentially allow Cohen to manage hedge funds using his own money. He also realized he could invest in other hedge funds run by his former employees. The vast majority of returns came from an investment in Melvin Capital, which delivered a 47% return in 2020 without the hidden edge enabled by insider trading. Point72 was no longer generating the massive returns SAC once did. His only hope was to invest his money in other hedge funds that might possess a hidden edge. Known for bold bets and wild returns, Gabe Plotkin was a superstar portfolio manager at SAC. With Plotkin, it truly seemed like extremely strong stock picking was taking place. He had long-standing management experience, having been at SAC since 2006 and later at Point72. In recent years, Gabe Plotkin consistently outperformed the market, much like the old Steve Cohen. However, neither Cohen nor Plotkin could have predicted that a group of amateur investors on Reddit would move against them in their own interests. Hedge funds generate billions of dollars for wealthy investors. At the forefront of this growth stood Steve Cohen. The secret behind Steve Cohen, who single-handedly turned a small fund into a $50 billion empire by nearly doubling it year after year, was revealed to be insider trading. After being exposed by authorities, Cohen was forced to look for new ways to make money. His new firm, Point72, began generating strong returns by investing in other major funds founded by his protégés. Point72 was regaining its former flash and prestige, but Cohen's newly found success would be challenged on January 22, 2021, by the most unexpected group of people imaginable. Approximately 140% of GameStop's publicly available shares were sold short, so heavily shorted that it created the conditions for a short squeeze capable of destabilizing the stock market through the wild movements seen in stocks like GameStop. GameStop is the retail store where you buy video games and hardware. GameStop is something we truly need to talk about, because by late January 2021, it was being pushed sharply up and down by enthusiastic retail investors. Melvin Capital suffered heavy losses. 53% of its investments were fighting for survival. Cohen invested $2.75 billion by partnering with Citadel in an effort to stabilize the situation and save millions. During this episode, both hedge funds and capital suffered major losses. It was an unexpected shock to the entire hedge fund industry. It is safe to say that Point72 has lost its edge in recent years. Cohen expanded his investments into venture capital strategies and similar areas. All of this was part of a search for new alpha. However, due to constant regulatory scrutiny and negative public perception toward hedge funds, Cohen has essentially retired from an active role. Follow your passion, because everything is not about money, right? Money comes from success, and success comes from being passionate about something and then doing it to the very best of your ability no matter what. Steve Cohen's story reveals a hard truth about financial markets. Beating the system is not just about intelligence, it is about instinct, discipline, and sometimes walking dangerously close to the system's limits. He turned a small fund into a multi-billion-dollar empire. He reached the top, fell, and reinvented himself. But this is not just the story of Steve Cohen. It is the story of modern finance itself. A world where risk is rewarded, mistakes are unforgiving, and a single decision can change everything. If this documentary helped you see the financial world more clearly, consider liking the video and subscribing to the channel. Turn on notifications so you don't miss our next deep dive into the forces that shape money, power, and history. And remember, money is not the goal. Passion defines the path, and money follows.